If you're interested in producing consistent passive income from the stock market, I'll share my secret for doing just that in this video. I'm Seth Freudberg, head of options trading here at SMB Capital, one of the top proprietary trading firms in the world with numerous 7 and even 8-figure traders. So you've come to the right place to learn. With the Fed now clearly signaling that it's going to begin a campaign of interest rate cuts to hopefully lead the economy into a soft landing, there's going to be an increasing focus on dividend stocks for income, as fixed income securities are just going to be yielding less and less. But the sad fact is that the average yield of an S&P 500 stock is 1.32%, which is basically terrible if you're looking at your investment portfolio for both growth and yield. And so the very simple option strategy that we're going to be teaching you today is going to be an eye-opener, because we're going to show you an example of how using this options technique on Pepsi stock last year would have more than quadrupled your cash income from the stock. So if that sounds of interest to you, then stick around, because I think you're going to find this to be a game changer for you. Before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so let's head back to January 19th of last year. And as you can see, Pepsi stock, trading under the ticker symbol PEP, had a comparatively good 2022 compared to the rest of the market, which you'll remember was experiencing a very bearish year. It was actually up slightly for the year, but then began to sell off in early 2023, and by January 19th had opened at 171.28, down almost 8 points from where it opened the year. And so let's say that you had owned 1,000 shares of Pepsi on that day. Well, at that time, with Pepsi trading at 171.28, the annual dividend you would have received over the next year would have been $4.95, which comes out to a return of $4,950 a year, or 2.89% in percentage terms, which is above the average for the S&P 500 for sure, but nonetheless almost half of what you could earn today simply keeping your cash in a money market fund, most of which yield right now over 5%. And so if that wasn't a satisfactory yield for you, then let's turn to the options market to solve that for you. So suppose on that day that you pulled up an options chain expiring exactly a year later on January 19th, 2024, and you looked for a call option with a strike price that was no closer than 5% higher than the stock is trading, which in this case is the 180 call, and you sold 10 of those for a price of $10.45, and then you headed down to the put side and sold 10 puts at a price of $7.60, which are, again, no closer than 5% below the market, which in this case is the 160 put. And we picked 10 calls and puts intentionally because we own 1,000 shares of Pepsi, and one options contract represents 100 shares of stock. And so we basically are selling a quantity of puts and calls that reflect the number of shares that we own, because the 10 calls relates to the right to buy our 1,000 shares from us at a price of 180, while the 10 puts reflect our obligation to buy 1,000 more shares of Pepsi at a price of 160. And so when you do that, when you sell calls on a stock that you own above the stock's trading price and sell puts below the stock's trading price expiring on the same date, then you are entering into what options traders refer to as a covered strangle trade. And it's a popular strategy for traders and investors who are seeking much more income from their dividend stocks than they could earn just by outright owning the shares of stock. Okay, so now let's take a look at what has happened here from a cash flow standpoint. And so we sold those 180 calls for $10.45, and each one represents 100 shares of Pepsi. So we multiply that by 100, and we sold 10 of them, so we multiply the whole thing by 10, which results in cash income of $10,450 from the calls. And using that same kind of logic, we receive $7,600 for the puts, resulting in a total positive cash flow of $18,050 when you first execute the trade. It's important to remember that if Pepsi closes above 180 on the day these calls expire, under the call contract, you'd be obligated to sell your Pepsi shares for a price of $180 per share, which is about 9 points higher than it's currently trading, so that's not really a bad thing, is it? On the other hand, if the stock closes below 160, then you'll be required to buy 1,000 more shares of Pepsi at 160 per share, which is quite a bit below where it's trading now. Let's move to the day that these options expire, which we intentionally set to be 365 days later because we want to contrast traditional ownership of 1,000 shares of Pepsi with the covered strangle strategy. And as you can see, after initially rallying in the earlier part of the year, Pepsi ended up actually selling off for the rest of the year, closing on the day these options expired at a price of $165.78. And so turning to our options trade, because the options have now expired, we can assign a final settlement value to them. And as you can see, that's going to be pretty easy because starting with the initial cash flow of $18,050, focusing on the 180 calls, well, those clearly expire with zero value because there's no value to a right to buy shares of a stock trading at 165.78 if your right is to buy them at 180. And so those go out worthless. And as to the puts, there's obviously no value to a right to sell your shares at 160 when you could sell them in the open market for 165.78 per share. So the puts also expire worthless, meaning that all of the options expire worthless, resulting in you simply pocketing that original $18,050 that you received at the outset of the trade. And that becomes your trade profit because both options expired without your having to either buy more shares or sell the shares you had. The options just died. They just expired worthless. And so now let's just do a comparison. And as you can see, the contrast is stark with the share ownership yielding, as we mentioned earlier, $4,950, while using the covered strangle strategy, we bring in $23,000, which is more than quadruple the simple share ownership cash flow from dividends, as you can see. Now, it's important that we emphasize two things so that you fully understand the parameters and the responsibilities of this trade. And so first of all, you really would need to think about whether you're ready to sell your shares of Pepsi at a price of 180 because that's the call's strike price. And your shares will be called away at that price regardless of how high the stock goes by the time the options expire and regardless of what capital gains taxes you might have to pay on the shares, assuming your cost basis was lower than 180 per share, of course. And so if you aren't willing to sell your shares at 180, then you should consider picking a higher call strike price than 180, which is also going to mean that you'll bring in less cash flow on the trade because the higher the call strike price, the less options premium you're going to receive for it. And similarly, are you ready to buy 1,000 more shares of Pepsi at 160, which is where the put strike is located? If not, then pick a lower strike for which, again, you'll receive less positive cash flow initially. In any event, whatever put strike price you pick, you'll need to have enough cash to buy 1,000 shares at that price. And so what I'd like you to take away from today's video is that if you're looking for additional income from your shares, particularly in this environment where yields are going to start dropping, you may want to consider the covered strangle strategy, which can be a very attractive alternative for you to pick up way more yield than you would have simply picked up owning the shares, as you can see from this example. Pro options traders are aware of all these strategies and they use them strategically to grow their accounts. And there's no reason that individual retail traders can't do the same as long as you're fully aware of the risks and rewards of the strategy.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.